Treasury yields ticking higher right now as the market awaits the Fed minutes later and a 5-year auction later today. The dollar holding steady despite a tumultuous May and concerns over its stability in the wake of some of the recent policies. Our next guest is out with a new op-ed asking, does Trump really want to sacrifice dollar dominance? Joining us now is former Goldman Sachs Asset Management Chair Jim O'Neill, also served as Treasury Minister of the UK, Chairman of Chatham House. It's great to have you back, Jim. I personally feel that a lot of this dollar dominance coming in question is a little overblown. Why do you not?
Well, I thought what I wrote in that piece to some degree back in November when the mood was so bullish about what Trump would mean for the dollar. But you could be right. One of the few things I learned in nearly 40 years of looking at foreign exchange is that these things go up and down unless they go down and up. And it's pretty easy to be wrong. So you're right that a lot of people are talking about it now. And I myself thought about 2 weeks ago that the dollar was trading a bit better and it might trade a bit stronger. But every other day, this president is chipping away at many of the fundamental things that have underpinned a lot of the things that you might argue are the exceptional strengths of the US, whether it be the position of Harvard University and in itself or its representation of many other leading US universities, whether it's its focus on fiscal stability, or whether it's, of course, the tariffs with the remarkable game he's seemingly embarked on with Europe. And if tariffs end up anywhere near the level that Trump talked about less than a week ago, I'm not sure the optimism that your previous guest, I'm sorry I didn't catch his name, talking about the incredible things going on in AI. I think Dan's optimism could be severely battered with how EU responded to the US imposing such high level of tariffs. The rest of the world is not going to sit there and just take whatever the US wants at it. And it's the service sector where obviously the US has benefited the most from many decades of globalization.
We could pick apart every single one of those arguments, Jim, but overall, I mean, the overarching theme is what is the alternative? I mean, Christine Lagarde of the ECB gave a speech this weekend saying, okay, it's Europe's turn to get the global euro. Nobody really thinks that that's going to be the next reserve currency, do they? And China is not open and freely traded in a way that the U.S. is. And you cannot compare policy stability in China to the United States. So I guess it just comes back to the age-old question of what could replace it.
Yeah. I've written and thought over the decades many a time about alternatives to the dollar, and I've often been wrong on it. So you're right to raise those questions. However, what I reply back to that, what is also a very common view, because it's not obvious what is the alternative. I don't think the real alternative will actually only appear until after everybody knows it's become it. Like any of these other things, you know, the pound was the dominant currency in the world until it wasn't. But more substantively, in translating it into now, it won't stop some very conservative holders of global assets thinking, well, I don't know whether the euro is going to be the alternative, but I'm going to put some of my money there just in case this guy carries on chipping away at all these issues that have made the US so strong. And that means, in a way, and that might explain, if you look at where the dollar trades against many currencies now compared to the equity market, the pre and post tariff madness, obviously the dollar's hardly recovered at all, whereas the stock market has. And, you know, that would imply some kind of risk premium, or that the equilibrium long-term value of the dollar is implicitly being harmed because it's chipping away at US productivity strength, in my view.
Yeah, I was curious, Jim, what you thought of, like, the Philippines is an interesting example. One of the central bank governors there on Friday was asked about the Moody's downgrade here. We're looking at it, meaning trimming treasuries. It's one thing when other countries' debt is downgraded, but the U.S. treasuries, now that's a big thing. Do you think that's a commonly held view right now?
I mean, I'm going to contradict myself. I would agree with Scott Besson. Generally speaking, I always used to think Moody's was a lagging indicator because they have to be, really, because they're so careful and conservative. But nonetheless, it is a confirmation of what anybody that looks at the US fiscal situation in any kind of vague detail is thinking. And for those that don't, it's like a pretty clear sign of saying, this place might not be quite as stable as you wanted or hoped. And so I hadn't seen those Philippine comments, but I'm not surprised. And I'm sure there are many such reserve holders thinking along those lines. Whether they are actually moving money or not is another matter, of course. And they're probably not. But again, as I said to Sarah earlier, that, you know, these things we only know after they've happened.
Wait,